Quick sound check. Quick sound check. Quick sound check. Checking voice. Quick. All good. Good evening, everyone. Good evening. Good evening. Welcome aboard, everyone. Welcome aboard. And today, we are going to be doing a deep dive into a very misunderstood concept of the market, but extremely, extremely important for all of us as derivative traders to understand. And that is, the gamma and how, we should be working around with gamma, especially on a settlement day. Right. So I'll keep the floor open for questions, and I'll ask of your understanding to be with me, because as I start this session, I understand also that gamma is not something which is widely understood clearly, and the few understandings of this topic are borrowed heavily from the way the US markets operate. I like to mention at the top of this session that the way we do options trading in India, specific to our market, is very, 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 very different from the way the US markets operate. Right? That is the same thing for the market profile. That is the same thing for the order flow also. So even in the market profile and even in the order flow and the rest of the tools we use at charts.vtrender.com, we are not doing a copy paste of every single thing which is there in the US markets. So just want to start off with that kind of a disclaimer, because when you hear this word gamma, you will hear a lot of US based concepts around it. And I want to start off at the top of the hour by telling you very, very clearly that the option market of India is very, very different from the option market of the US. For one, we do not have market makers in the option market of India. And to know that, you have to look at nothing but the open interest positions of traders. And if you look at this open interest positions of traders, you look at pros and the clients, you'll quickly understand that the pros and the clients trade with each other. The market maker is an intermediary who comes in the market and functions as some kind of a buffer between the institution and the retail side. We have no market makers in the derivatives markets of India. They are not allowed. They are not legally allowed to function by our regulator. So anybody who talks to you in terms of options, especially when he uses the word gamma and he uses this word market maker, quietly laugh and move away, because that's not how the industry works out over here. Right? So top of the hour, you need to understand that the pros and clients are the major volume drivers of the options market. and they trade with each other directly, and that's underlined. They trade with each other directly. There is no other player in between. The pros trade with clients, the clients trade with pros. Sometimes the pros win, sometimes the clients win also, right? So that's another misunderstanding which is there, that the clients are not knowing what they do. And a lot of that misunderstanding is coming because of our regulator printing those reports. But the truth is otherwise, guys. A lot of clients do make money. And when we talk in terms of clients, I'm talking about HNIs, people who are trading for a long period of time. They put a lot of money in the markets, and you would know that by the kind of positions which are available on your screen right now. The second half, you'll see these build-ups over here: 13 lakh 99,000 in calls, 11 lakh 36. This is not somebody who does not know how to trade, right? So this is a fairly substantial retail clientele. Some of it and most of it is HNI, who know very well how to trade and who are profitable. That's why they show up in the markets every day, right? So people who are making money will come to the markets every day. It's only people who are losing money, they do not come back to trade, right? And if you know that there are people who are putting positions in the market, have open positions in the market, then you have to understand that these traders are profitable. They know how to trade, and because they know how to trade, you have to treat that position of theirs with respect, right? And we follow and we track all these positions, and that's how we move this forward. So I hope this part is underlined. I want all of us to understand that the Indian option market trades directly with each other, and there is nothing called a market maker in our markets, because this is a fundamental understanding, and it requires to be underlined and understood that we trade directly with each other. Now, because of this understanding, our entire outlook towards understanding the gamma and the option market at work will change. And bear with me as I walk you through exactly what is the option market all about, and how it works specifically on a day like today, which is a settlement day, and how it works out over here. So top of the hour, what we need to understand is something called option Greeks. And I'm sure all of you trade options, you understand that there are all these Greeks over here: delta, gamma, theta. The open interest is also there, and we have this table for all of you, which you need to look at. So under free access, you'll come across this term called Greeks, and this is the chart which will open up. This chart simply gives you a representation of current option activity by strike, which is in the middle. The settlement comes in. The calls are on the left, the puts are on the right. The settlement date is there. The 17th of July is right here, which we traded today. The next one is 24th July, 31st July, and 28th of August is also there, right? Now, by the very nature of pricing and the role of option Greeks, you'll quickly understand that all prices are different, and it's not just because it's different series and a different time element. The delta is also very different, right? Now, we do not need to go into those basics of all that is there in the option Greek, but I want all of us to quickly understand two very important terms over here. One is called delta, and the other one is called gamma. Now, I'll just quickly back off a little bit and try to talk to you about what this is all about, because the understanding of this is central to our understanding about how gamma, IVs, and the marketplace actually works on a settlement day. Right now, I'll just back off, and let's try to understand gamma in terms of you driving a car. Okay, say you're on the expressway and you're driving your car. The speed at which you drive, okay, that is what you call a delta. That is what you call the delta of the option. So suppose you're going at a speed of say about 70 kilometers per hour. You can say that you're driving at a delta of about 70. Now, what exactly does this delta mean in terms of an option? If the instrument, the option, moves in by about, the instrument moves in by about 10 rupees, delta of that option, if it is 0.50, will tell you that for the 10 rupees the instrument moved, the option would move by about 5 rupees. It's 0.50 delta or 50%. That tells you, okay, that the move would be 50% of the underlying. So suppose, okay, Nifty moves from 25,100 to about 25,200, which is a movement of about 100 points. If you have an in the money position, which has got a delta of 0.50, for that 100 points of Nifty move, your option will move by 50 points because the delta is 0.50, right? So this is very simple and it's very easy to understand that with the movement of the underlying, the delta of the option moves. But if everything, okay, was up to here and standard, it would have been a very, very simple probability math for us to understand. The complexity begins with that move which happens, right? So if delta for 100 rupee change went from let's say about you that 100 rupee point move happened, price increased by about 100 rupees, your option price increased by about 5 rupees, 50%, okay, of that. The option price increased by 50 rupees, the instrument improved by about 100 rupees, the option price increased by 50 rupees. All that is good and that is simple to understand, but the complexity begins after this price increase. The complexity is this, that that 0.5 delta does not remain 0.5 delta with the movement of the underlying. That delta changes and it becomes 0.65, 0.75, 0.80, depending on how much the underlying has moved. Now this is where our second friend comes in, and that is called gamma, right? So delta is your first option Greek. You need to know it absolutely if you're trading options. Okay, and if you're trading long options, long calls or long puts, we highly recommend, okay, that you choose a delta of 0.6 and more, because, okay, you will get that kind of a percentage move away from the markets. But it's not just, okay, about knowing delta, it's also about knowing, okay, what gamma is, and gamma is the game changer. Gamma, by definition, is simply the rate at which delta changes. So we know that when an option moves up by about 50 rupees, the delta is no longer going to be static at 0.50. It may move to 0.70. But the speed at which it changes from 0.5 to 0.7, that is where gamma comes into play. So if simply put, okay, if you're driving on that highway and delta is speed, then gamma is the acceleration. Gamma is why, okay, you would go at what speed. And traders, especially, okay, derivative traders, okay, who are trading settlements, need to understand, okay, what the gamma is, because gamma is different on different days of the week and it's highest on the settlement day, and which is why the gamma impact, okay, comes maximum, okay, in that last half an hour, 1 hour of trade, when moves are really very quickly. The gamma is highest, closest, okay, to the option going to a time value of 0, or what we call 0 DTE, and closest, okay, to that 3:30 p.m. time on the intraday scale, where you can say the acceleration is at the maximum, and a small change in the underlying, the Nifty or the bank Nifty or whatever instrument, okay, you're trading with, a very small change can create a large gamma effect, which can, okay, induce wholesome changes into the way the market is, right? So not just understanding of delta as derivative traders, okay, we got to understand what gamma of the instrument is, and gamma will tell you, okay, how much, okay, that option is willing to move for every 1 point change in the delta, right? So far so good. So we know delta is the speed and gamma is the accelerator. But now, okay, you have to start understanding two more concepts. And the first concept, okay, you need to understand is something which we call long gamma. Okay, and the second concept after that is obviously the opposite of that, what is called short gamma. So you've got to understand, okay, what is a long gamma market, and you've got to know, okay, what is a short gamma market. A long gamma market is simply a market, okay, where you are owning options, you're buying options, you're expecting the market to make big moves, and every time the market makes big moves in either direction, either through a long call or a long put, you are benefiting, and you can say that you are long gamma in the market. You have bought calls, you have bought puts, you're expecting the market to put in a big directional move, and that's why you're positioned yourself that way to profit from the movement of the market. The opposite of that is what is called short gamma, right? Those are your sold options. That means those traders are positioned to benefit from moves which are not big in direction. So they will make money when the market is not moving, and they will lose money when the moves are big, right? So this is a fundamental concept we need to understand as we approach this gamma play. Long gamma traders would benefit from a big directional move. Short gamma traders would benefit from no moves in the underlying. So, and as we move closer to settlement, as expiration approaches, we focus a lot on the at the money options, because that's where the concentration of gamma is, and it's like a spring, and the more compressed it gets, it tends to explode more. So that's why you have these terms which float off in the market, something like gamma hulk and smash and explosion, gamma explosion, etc., because it's the concept is of a spring which got coiled, and can explode any time into the market. Right now, I'm just gonna show you which chart shows you what. But what we do is we plot this gamma, which is nothing but acceleration of the change in delta, and we plot it into the market to understand where the market is focused. And what we are focused on is traders who are short gamma, who have sold option, because we understand that these are the traders who are making money. Now, why do we make that assumption? You need to make that assumption based on the holdings of traders. So if you look at where this is, I come to this table, which is the participant-wise holdings, participant-wise positions, and I click on pros and clients. So just to understand what I said at the start of the session, if you look at what the FIs are doing in the option market, and I know a lot of new traders tend to follow the FI work, but FI, these are contracts. So these are contracts in value. So this is number of contracts traded. The net of FIs in futures is large, but in the options, it's negligible, minus 37,000 only. In the puts, they have some exposure for that long position they hold in stocks, etc. So FIs by nature are not primary weekly derivative traders. DIIs are also like FIs. They are not into the options market at all. So you look at this, you look at futures, there are about 9,000 contracts, which is negligible, nothing at all in calls and puts, and some of them have got restrictions. They cannot really trade the derivatives market. But be that as it is, the real money is between the pros and the clients. And if you look at this, you'll see that it's basically a net short contracts by pros. So there were 224,000 contracts, and this is not just one day today. It's basically over a period of time. They are basically short gamma most of the time. They are sellers of contracts, call options, and sometimes put options also, depending on how they would like to see the market going. So if they think the market has got no more scope to go up, they would be shorting calls. And if they think the market has got a good downside, they could be longer gamma also and buy puts also. The clients, yesterday, as of yesterday, they were long gamma, so that's about 262,000 contracts. They were short gamma in puts. So basically, the assumption which we make is that a lot of money is short gamma in the markets. Sometimes it goes long gamma, and we track where this market is going long gamma and short gamma, and we track this into what we call the Nifty gamma value chart. So you go into this, you plot gamma value sum, and this is the picture as of right now. The market closed at 25,100, and the gamma positioning was heaviest at 25,100. Now this is a dynamic picture of the market. In fact, even yesterday I was posting this chart about what the gamma was yesterday at the close. I just shifted the date to yesterday, and the settlement is still on the 17th. The settlement is still of the 17th of July, but I posted this chart at 3:30 p.m. yesterday, 16th of July. And yesterday, okay, the gamma was high at 25,200. Now, why was this significant and why did I post it? Because this gamma at 25,200, it said 75,000. This number by itself is not really an important number. It's relative to the rest of the market, but it told me that it was twice of what was there on other strikes. So this is significant. So sometimes, okay, we say the market whispers. Sometimes we say the market shouts loud. And this was, okay, one of those markets, okay, which gave me, okay, what I called, okay, a very good Gaussian distribution. This is a high-tech probability curve, okay, which steps up. And every time I see a market like this, this is a market, okay, which is not whispering, it's shouting. It's telling me, okay, that this market, okay, wants to pin at 25,200. So the central reason, okay, of posting this yesterday was, okay, I was aware that the gamma, okay, was almost double at 25,200, and probability wise, okay, this was, okay, a large reason, okay, for the market, okay, to open flat. That was one thing, and to stay flat, okay, mostly into the close today, right? So this is, okay, what it was at the close, and I'll just change that chart to today's date. And this is, okay, how it opened. Right at the morning at 9:15, this was the picture. 25,200, okay, was our big strike. And if I just go through this with you, at 9:30, it was still the biggest strike. Market, okay, was coiled around that 25,200. 25,200 at 10 a.m. also was the biggest gamma strike. At 10:15, and if I go into 11 o'clock, 10:45, it was, okay, the biggest gamma strike for a long period of time. At some point, okay, around 11:15, okay, the 25,100 started picking up value. This was maybe some of that early smart money starting, okay, to start looking at 25,100 and 25,150 as possible reasons for expiry. Now, why is this chart important? This chart, okay, is telling you, it's like a market's crystal ball. Everything, okay, over here which we do is in terms of probability. But what we have to understand about probability is that the market is open, right? And every single hour, every single half an hour, every single 10 minutes, every single 3 minutes, the market is open. Every single 1 minute, the market is open. Data in the market changes, right? Volume keeps coming in because the exchange is open, and because volume keeps coming in, data, okay, keeps changing, and what was happening yesterday is no longer valid, and today's, okay, situation, okay, is likely to be different, right? So these traders, they just didn't enter positions yesterday. They were also monitoring, okay, what was happening in and around those positions, because, okay, some of these people who have created positions because the market is open are no longer the only traders in the markets with a position. Other people come in, they build positions. Other institutions can come, they build positions, and not all those positions could be for the settlement dated 17th of July. Okay, some of those positions could be for next week. Some other institution, okay, may suddenly start looking at the next expiry as a movement downwards, so it will pick up positions in the next week contract, or somebody will pick up a option position, a large option position in the August contract. So people keep adjusting, people keep making changes, and existing positions also are booked. And that's why it's very, very critical, okay, when the market is open, that you do not rely on yesterday's data. Now, I say this, okay, with a lot of emphasis, because I always, okay, get a lot of traders who walk up to me and say that yesterday, okay, you said this, and today, okay, you're saying this. I'm saying this because the market is giving different information, and I cannot live in the past. I cannot go by what has happened yesterday. The market is different today. The market is gonna give me a new set of information, and I better be alive to that new information which is coming in the market at that moment in time, right? So one of my friends, okay, he always says this: when the market is open, garden mein nahi ghumne ka. You have to pay attention to what is happening in the market. Yesterday is gone. The data, okay, which was presented yesterday is already built into the market. The market is appraised. The market has priced it in, and what it is now looking to do is move forward, right? So just stay alive, okay, to the possibility of new information coming into the market. So this is okay, what was happening right up to 12 o'clock. Okay, the position was the same. 12:30, okay, it was the same. By 12:45, it was still the same. And by 1 o'clock, stayed the same. By 1:30, notice, okay, what happened. The entire position, okay, had shifted. So 25,200, which was the dominant gamma wall at that point of time, where all the short volume, okay, was built in, had shifted into 25,150. Had shifted into 25,150. Now, what did this shift tell you? This shift told you that people were expecting 25,200, okay, to be the close of the series. That information which the market, okay, had built in yesterday and today in the morning has shifted now. So it's no longer expecting 25,200, okay, to be the closing point. It's now expecting 25,150. Is this final? Absolutely not. It's a probability math. Okay, the market is still open and it's only 1:30. There are 2 more hours to go. And eventually, okay, what was happening is that these traders, okay, were adjusting positions. Now I'll walk you through, okay, how the positions were adjusted, etc. But finally, okay, what really happened as the market progressed, the gamma, okay, came down, okay, into about 25,100, and we had a close which happened exactly, okay, where the market, okay, made those changes to be right. Now the reason I focus, okay, on this chart, and you need to understand why this chart is extremely important, because what we look at in this chart is the market's assumption of where it would close on settlement day. Now, this is not based on some price derived factor. This is based on positioning of the market, existing trades taken in the market. So I'm not, okay, doing a calculation based on some quant or some random probability analysis of finding out what the market is expected to do. What I'm doing instead is working, okay, with the existing positioning of the market, where these positions are expecting the market to go at. So I want to be very clear, okay, in this understanding, because a lot of people, okay, when they come into the world of gamma, they start looking at it in terms of probability outcomes, and then they'll use statistical models to arrive at a range or a ratio or an expectation of where the market is going. We don't do all of that. We instead, okay, focus, okay, on what the positions of the market are saying, and wherever, okay, this position shifts, the gamma zero, that is the expected price of the close. Ideally speaking, in an ideal world, it should not shift at all, because the gamma zero is where the position where the market is expected to close. But hey, data keeps changing in the market, new information keeps coming in the market, and some traders close positions. Some traders, okay, who are profitable in that straddle, like this 25,100, 25,200 straddle, we were into this 25,200 straddle all day today. So let me just bring up that options table. So this was a very good trade for us in the morning today. All of us, okay, in the room, okay, had gotten into this 25,200, and we had gotten it at about 80 rupees today, right? Early in the morning, that was, okay, the price, okay, we got in, and we saw, okay, price dipping. It went up to about that 70 rupees, and then, okay, it spiked up to about 90 rupees. And then there was a point at about 45 rupees. So it went up right up to about 40 rupees. This was the point at which, okay, the depok shifted. So we'll just zoom in on the left. This is that 25,200 strike. So we opened up, okay, around 80, and we all got ourselves, okay, because of the gamma factor. But right around over here, at about this 40 rupees, you will see this white line shifting lower. Now, what is this telling you? Right around over here for this 25,200 straddle. This was 40. This is the time, okay, we closed our position, because we knew, okay, that this move was done. And we were right, okay, because, okay, the M flow, the DOI, the M flow and everything, okay, went red, and people, okay, started, okay, trading out of positions out over there. So what I can do is, on the panel controls, we had the M flow put up. right? And this is the M flow, okay, I've added. So somewhere around here, we had this very big spike, which came up in this strike, and virtually, okay, no greens, okay, got added. So all of this money had started, okay, moving out, and this was no longer viable to hold as a straddle into the close. Eventually, it went up to about 87, didn't cross, okay, into yesterday's 120 zone, but still, this was an exit signal, okay, which had got triggered, okay, around this price of about 40. Right, so we use this, okay, with the M flow indicator these days, because the M flow is a powerful tool for us to understand the flow of money. The flow of money stopped coming into green from this point when it spiked up above the depot, and it crossed above VWAP, and all of that money, okay, had shifted in. Right, this was that changing information which came in, and the net result of this was the impact, okay, it made on the order flow chart or the instrument, okay, 25-200 PE. So if I just quickly, okay, plot to the 25-200 PE, this is the change which the market, okay, was forced to do later in the afternoon around that 1:45 p.m. Right, so somewhere around here, a lot of these greens, okay, came in, and the market, okay, started, okay, moving up above the initial balance. So all these zeros and all these greens, okay, were telling you that there was a liquidity crisis around here. So every time, okay, we see these zeros, we know, okay, that there is a lot of stop losses in the market. And if you've been, okay, to the ECO's content and the training library, you know, okay, that these are what we call continuation patterns, and they become stop losses, okay, for a future trade in that direction. So we were expecting this to be support, and the minute, okay, these came in and all this covering, okay, which had happened over here, this was a signal, okay, that you had to get out of that 25-200 PE, and this eventually, okay, moved up all of this, okay, close into the final closing minutes of the day. This put pressure, and this is, okay, what the gamma of the market, okay, was all about later in the close. Right, now just to back off and come back, what we are looking for in the gamma chart, so you can plot it as a sum, you can do it as a split also for you, okay, to understand what it is. And if you want to see change, you can put the writers, okay, what they are doing via this chart also. So all that closure of writers is right here in the 25-200 PE, which I just showed you, and the 25-150 call and the 25-100 call added into the close. And this is, okay, what was the reason, okay, the market, okay, went down in the way it did later in the close yesterday. Right, they were comfortable for a very long time, okay, the 25-200 PE was comfortable right up to about 2 p.m. But the actual change right up to about 12:15, okay, they were comfortable, but right around 1:15, 2:15, okay, is the time, okay, they started moving out. By about 3:30 p.m. they had to, okay, liquidate that position. So you can find that out, okay, by writer's cash, but you can, okay, keep this. Now again, okay, just to, okay, reiterate, we are tracking this as the market's expectation of where it can close for that day. Is it absolute? No, not at all. Okay, the market, okay, works on an assumption. It's probability based, and because the data is live, because the market is live, it has to keep changing. It has to, okay, keep looking at that new data and keep changing its view also. Right, so you'll see, okay, this happened regularly, but towards the end of the session, okay, wherever, okay, the gamma is value is, that is, okay, the assumed close of the market. In a sense, you are reading the market's mind by keeping this chart open, and if the skew is good, that's the time, okay, you take some very good positions for yourself. Now, what was different, okay, about today right at the open was this skew. I told you, okay, this is a very good skew, okay, to take a position on. But if I look at that next expiry, which is on the 24th, the coming Thursday, this skew is not speaking to me the same language, right? So this is 24th as of today's close. This is a completely different skew. So it's still around 25-200, but this is not giving me the same kind of confidence which the other one had in building a strong gamma position at 25,200. So some of these strikes are missed and away, and this tells me that this is still under development. This is the 24th July expiry. So again, not every single time the market is going to give you the same messaging. Sometimes it whispers, sometimes it shouts loudly, and you have to see what best you can do to understand that situation. Okay, now along with this gamma, what we basically done is we introduced something which we call the spectrum chart. Now the spectrum chart is nothing but your gamma chart, all that explanation I just did about that bar chart with probabilities added, right? And what we have, let me just remove all the factors and just show you what this chart is right now. So this is the gamma chart which you have been seeing all day in that other chart. This was at 25,200. It went up to about 25,150, around 250, and it came down to close at 25,100, right? This is the gamma zero level where the market is expected to close. Now this is a dynamic number which keeps changing, right? Now the market does not change its view for every 5 rupees of change in the underlying, because the concept of gamma is such that they understand that it's going to change, but they are not pricing in a change for every little move in the underlying. So what the market does, it works in a probability about how high it can go and how low can it get, and that probability is represented by these yellow lines. We call them market visualization low and a market visualization high. Now these are probability analyses. Okay, this is based on existing positions of the market. They are not trading positions. I want us all to understand the key differentiation over here. These yellow lines are probability analysis based on data about where the market expects to go if there is a move coming in. This is not the same thing as positions which are reflected in this dotted line, right? So as the market moved early in the morning around 10:15, the MVIS quickly adjusted to about 25,000. So this was the built-in plan for the day by smart money, and they were open to the market moving to about 25,100 at the close. On the higher side, they did not adjust this number, which was about 25,200, and the market did not cross about 25,200 all day, right? So we've added this MVIS high and MVIS low, which is the probability of a move to happen. And if the market stays within this range, 25,200 and 25,090, there is a 96% chance the market expects to stay within this range. So this is the lower value, and 96% of the time the market is not gonna go beyond this level, right? And this is the higher level, MVIS high, MVIS low, and generally you'll find that the market is moving between these levels over here. If this adjusts lower, and it's a dynamic number and it can keep adjusting lower, that means the market is adjusting inventory. So you'll quickly see that the volume in the market is changing, or that traders who were previously hedged have let go of one part of the hedge, or they are adjusting their delta position, or they are doing something else to manage that position which they had. Accordingly, the MVIS low will either go lower, or the MVIS high will again change if they are expecting the market to change it, right? So you can keep this chart up open. You can add these points whenever you feel like. I recommend that you add it, the MVIS high, the visualization high, and the visualization low, because that tells you immediately how much the market expects price to move. And this is to be managed, especially on a settlement day where the market is expected to move, right? So I hope this is I know it's a little bit complicated to understand, and it flies in the face of a lot of you doing price based trading. There are two approaches to the market. One is to keep following price and to go where price goes. We call them no offense to anybody, but that is called bhav ke khiladi. You keep trading price, you keep tracking price, and you go where price goes. Purely good approach. It will tell you what price is good and what price is doing, and you keep following price. You will make money. The other end of that is traders with existing positions in the market, and these are traders who we love to track. And the central idea of doing what we do at Vtrender is to track these traders who have got these positions in the market. So we track them through what we call the market profile charts, which show us buyers and sellers, and we'll keep looking at points in the market where buyers are stronger, sellers are stronger, etc. We keep tracking them through our order flow charts. We look at where the large traders are coming in, and again we are looking at positions of the market, traded quantities, people who have got skin in the game, money in the market, positions which are open. We track them. Okay, and that's how the order flow chart works. We have something which is called the M flow. We did a few presentations on the M flow instrument, which is again existing positions of the market, whether it is closing or whether it is adding. So M flow being green is telling you that the market is adding positions. Again, the concept over there is that we are tracking money in the market. And then we have the NTM charts, also the volume change charts, the NTM Volex charts, which again tell you the options position. This is the NTM Volex chart for the day. Very simple and very powerful tool. Simple to understand, but very complex in its working. But it tells you which side you have to be in. Purple above blue will tell you that it is a sell side bias in the market, and you've got to take a bearish view in the market, right? And the opposite is that the blue over purple will tell you that the market is now bullish, and gives you an idea that you have to establish positions on the bull side. So this is another one of our tools, and what we are trying to do over here is trying to understand where money is moving around us, and where money is moving around the positions we are taking in the market. So we say this all the time: we do not trade in a vacuum. We trade with a number of fellow traders along with us, around us. And what we do is we try to understand what kind of positions they are in, whether those positions are profitable or whether those positions are in loss. And we align ourselves to their ways of thinking, to their ways of trading, such that we know that if there is a large trader who's aligned with us, then our chances of becoming profitable increase. Right? So all these are tools which we have developed for you to get a small edge into your decision making process. At Vtrender, we are not doing something which is available commonly outside. Like I know a lot of you use your open interest charts, etc. We don't want to replicate what is available outside. Everybody is doing it. Why reinvent the wheel? It's already working, it's already there. Use it over there. But what we try to do with our order flow charts, with our market profile charts, with an M flow, with an NTM Volex chart, with the gamma positioning, the gamma spectrum, etc., is to give you tools which give you that additional edge which 94% of the other traders do not have. And that hopefully builds an advantage for you, and gives you an idea about how big money is positioned in the market and whether your positioning is right or wrong. Right? So go over these tools, go over what is mentioned over here. We hope you can utilize it to your advantage and you can get good at it. I've tried to talk to you today about how gamma impacts markets, and that was the core of what we spoke about. Higher gamma creates higher volatility in the markets. Higher volatility in the markets would improve or increase those IVs, implied volatilities of the markets. Whenever high IVs are higher, when IVs are higher IVs would attract more of the professional money, who may either look to buy puts or sell some of those calls, because the IVs are to be used to trade. So that attracts a lot more option trading, and more option trading translates more into gamma. And that's where we started off from, right? So the gamma is like it is like a feedback loop. It's a circle which goes round and round and round, and especially on settlement day, understanding this circle is critical to the way we work forward. right? So I hope, okay, this is clear. I hope, okay, this is clear to all of us. The next settlement, okay, I want all of us, okay, to get very good, okay, at the understanding of gamma. That's the acceleration, okay, which drives, okay, all those big moves, okay, which come into the markets. I've shown you, okay, how to use those probability charts in the spectrum. This is, okay, where the market expects price to go to. The density charts right here, market visualized, and we are adding, okay, two more tools, okay, to this concept, okay, such that, okay, you'll have a 100% understanding about how the big money is trading out over here. The most important thing over here is that these charts are live and they are dynamic, and they are coming in from with data directly from the exchange. Now that makes it no longer a theoretical assumption. We don't believe in putting anything on the charts which is based on theoretical math. This is actual positions of big traders or all traders in the markets. So this is actually money which is speaking to you, existing money in the chart. So whatever skews we look at, whatever gamma we talk about, whatever order flow volume, okay, which is there, all is related, okay, to an existing position in the market. So I hope, okay, you can utilize it, understand, okay, what are the forces which go behind price and drive price action. It's not just about following price, it's about knowing what are the forces which drive price. And the bigger, better traders, what they do is they anticipate what can happen. They are not people, okay, who react to a certain situation which happens in the market. That's the traders, okay, who are always behind, who are always losing to money. The bigger traders, okay, what they do is they understand the underlying mechanics. Simple things like, the Greeks, the deltas, the gammas, they know that if they're taking an option, the delta change, okay, would impact it in what way, the gamma change, okay, would impact in what way. And they know all this, and that's why, okay, they are very, very good at what they do. So they position themselves, okay, with this knowledge, and that's how, okay, they are constantly winning, and that's how, okay, they are constantly, okay, making big profits from the market, right? So I hope, okay, this was useful. And this world, okay, of options is truly a very, very dynamic place, which can, okay, bring the best out of you if you really, okay, apply yourselves with the concepts, okay, which you have, and you take it forward. At least, okay, to begin with, whatever, okay, you do, just start watching this, okay, on for a few things. Keep the charts up, watch, okay, a few settlements with this. But if you get good at it, you'll have a massive edge for yourself as you go onwards on this journey, right? So I'll sign off from here. There's going to be a recording of this on YouTube as well as on my X channel, and I invite you, okay, to view it again. Some things, okay, require more than one viewing, and I hope, okay, you do that and get good at the business of trading. Thank you for joining in, and I'll see you, okay, around, okay, for the next one. Thank you all, guys.